Hello everyone, welcome back. We are now in chapter 4, and in this chapter we'll be discussing a brief introduction to the financial statements. So far we have discussed the accounting basics. We discussed various accounting concepts. We also discussed the accounting process that goes into the preparation of balance sheets and other financial statements. So in this particular chapter we'll be having a very brief introduction to the major financial statements that you'll be encountering in the process of credit appraisal. Please note that we will be having a very detailed discussion in the future chapters. Chapter 5 will be dealing with item-wise discussion of profit and loss account. So there will be discussing each and every item threadbare, and in the subsequent chapter we'll be discussing each and every item of the balance sheet. So what this chapter actually does is only provide a brief introduction to this major financial statements. Right? It is not a detailed discussion. It's just intended to give you a feel. Right? It's just intended to give you a feel of the financial statement that we'll be encountering. Okay, so this is not a detailed discussion. Don't worry if you're not able to understand many of the terminology that we'll be encountering here. Okay, so traditionally there are two important financial statements, right? Two major financial statements. One is the P&L account and this is the balance sheet. So traditionally these are the two most important financial statements. But sometimes the P&L account is segregated into two parts: the trading account and the profit and loss account. So in most cases you will be encountering a single statement called profit and loss, but there might be certain instances where you'll also encounter the trading account and the profit and loss account. Actually, trading account is just one portion of P&L account. So what happens is there will be two parts, right? One is the trading account, another is the P&L account. So in this particular trading account, we'll arrive at what is known as gross profit, right? We'll arrive at gross profit, and then this gross profit goes into the P&L account, and then we'll have another set of expenses here, and finally we arrive at the net profit. So you usually don't see this much, but in case you see, please remember that this is just a one way of presenting the P&L account. In most cases you'll be encountering straight away a single P&L account. You won't see the segregation between trading account and the P&L account, but should you encounter such cases, please remember that this is just one form of presentation, right? Then besides P&L account and balance sheet, we also have some other statements called the cash flow statement, and there's something called the funds flow statement. So what we'll do in this particular chapter is we will just take a look at the P&L account and balance sheet, right? Because these are the most important statements, and cash flow statement and funds flow statement we'll be encountering in a future chapter. So as I told you, these are the five major financial statements, right? The trading account, the P&L account, the balance sheet, cash flow statement, and the funds flow statement. So in this chapter, let us take a look at the P&L account and balance sheet and cash flow statement, how they look like, right? We'll just just have a feel of the financial statement. So let us take a look at a profit and loss account. This is profit and loss account of Bajaj Auto, one of the largest companies in India. Just to give you an idea as to how a balance sheet, as to how a P&L account looks like. So here you just try and see what are the striking features that you can observe from the P&L account. So one thing you have to observe straight away is the P&L account says it is further year ended, right? So P&L account is for a particular period. Okay, when it's saying for the year ended 31st March, what it's saying is this is for the period 2011-2012. For this particular year, this is the P&L account. Please have this point very clear. P&L account is not for a particular date. It is not. This is Bajaj Auto's P&L account for 2011-12. So this P&L account is not for this particular date. It is for a particular period, and this period is 1/4/2011 to 31/3/2012. So this is for a particular period. This is for a whole year. We will encounter another financial statement called balance sheet shortly. There you will see balance sheet is for a particular date. So balance sheet is prepared on a particular date. So balance sheet, in the case of balance sheet, it is for a particular date like 31/3/2012, right? Which means the balance sheet could be totally different the previous day, right? So 29 3 2012, it could be completely different balance sheet. Balance sheet changes from one day to another. Balance sheet is a static concept, right? Whereas P&L is a flow concept. Please make this distinction very clear. So when the heading of the P&L statement says it is a P&L account for the period whole year 2011-2012. So when we see an item called sales, what I'm saying, this is not the sales for this one particular day, 31/3/2012. No. So what we are saying, this is the cumulative sales for all the 365 days from 1/4/2011 to 31/3/2012. So this is a cumulative position of all income and expenses during this whole year, right? So to repeat, P&L account is for a particular year, right? It is during a particular period. So what P&L account in summary tells us is whether the company has made a profit or a loss for a particular period. It tells us what is the income and what are the various expenses, and put together whether it tells us whether we have the income is greater than all the expenses, and then in which case we'll be having a profit. The other scenario where the income is less than expenses will be having a loss. So P&L account tells us whether the company has made a profit. So this is what we have discussed. Each and every item in the P&L pertains to the particular period, April 1 to March 31st. And the sales which we already discussed is the cumulative sales for this 365 days. So P&L account is for a particular period. You might also have observed that the P&L account mentions 2 years, right? So we have a P&L account for this 2012, that is 2011-2012. We also have the figures for the previous year, that is 2010 and 11. This is a normal practice which you encounter in most balance sheets, right? Unless you are analyzing a very small balance sheet, like for a small proprietorship or partnership firm, usually for major companies or even a medium size company, this is a common practice where we'll be having figures for two years, right? Two separate years. One is the current year and this is the previous year. So this enables us to compare how the financial position has changed compared to the previous year. So in this example, we can see that the sales of this particular company has increased compared to the previous year. How much is increased you can calculate. So we can also see the profit. So compared to last year, the profit has actually come down, right? Have you observed this? The profit after tax was 339 in the previous year, whereas it is 3004 for this year. So, and these figures are in crores here. So yeah, this provides a nice way to analyze enables us to compare the movement of the figures compared to the previous year. You might have also observed that there is an item called notes to account. Okay, see here is a note number. So what this note number tells is there is some additional information available in this particular note. See for this item called other income. So you don't know what this other income is, but if you go to note number 18, right, what it is saying is additional information is available on this note. So these notes are provided as an annexure to this financial statement. So after this P&L account, and the next page you'll have a balance sheet, cash flow statement, and then we have a series of notes, numbers. So there you'll be finding some additional information regarding to whichever item we have listed here. See for example, we have a something called item called finance costs. So this is a separate note here. So if you want to know what is the finance cost, what is the interest on term loan, what is the interest on working capital, if you want the further breakup, you'll be having a information. So note number is a very important aspect. It drills down the figures, right? Additional information is provided in the notes, and it's very important to understand that notes are a integral part of annual reports, right? Notes to accounts, this additional information. There's something called schedules, right? Schedules, okay. They contain very important information, and whenever you see annual reports, you should read these schedules together with the figures. It gives you additional information. Then we have we'll take an example. So very crucial information is sometimes revealed from these schedules, right? So take this example of the company where we have seen the profit has decreased compared to the previous year, right? So in the previous year the profit was 3,339, whereas in this year it is only 3,000 crores. So if you want to see what's actually happened, there is this expense called exceptional item, right? And you can see it is a negative figure of 134. So there is some exceptional expenditure amounting 134 crores. In the earlier day we actually had exceptional profit. This is a one-time income. Some exceptional item is there, right? So we want to see why this profit has come down is actually because of this. So last year we had this one-time income of 724 crores. This year we didn't have it. Furthermore, we had a exceptional some expense. There's a 134 crores due to which the profit has come down. So if you want to see what actually has happened, you can go to note number 25. So let us go to note number 25. So this is what note number 25 for this company says. It lists the in detail what is the exceptional item. So here you can see this is a valuation loss on derivative hedging instruments, and that's why you have a 134 crores loss. This was not the case in last year. Last year we actually had an 724 exceptional income, and that income in the last year was surplus on prepayment on sales tax deferred liability. Okay, so last year also we had something called exceptional loss. In that case it was a provision for diminution value of investment in the Malaysian subsidiary, okay, or rather the Indonesian subsidiary for Bajaj Auto. So further details is available here. So in case you need further information, it's always available in the schedules. You need to go through this. Okay. The point here is, had this item not been considered, Bajaj Auto's profit would have been up by 134 crores. So the company has recognized this loss and thereby has taken a hit of 134 crores on its profit, right? So since this is a listed company, as a shareholder, this will have a major impact on the share price, isn't it? So compared to last year, the profit has come down, and this will actually adversely impact the share price. So you need to clarify to investors what has actually happened. So notes schedules such as this provide the required justification for what actually is happening. So to wrap up P&L account, you need to understand that sometimes we use the terms in profit and loss account and income statements interchangeably. Both actually mean one and the same. So the purpose of profit and loss account is to see what is the turnover that the company has achieved for this year, and whether the company has made a profit or loss. So it lists down the income, and it lists all the expenses the company has incurred, and finally arrives a profit or loss. So that is the purpose of P&L account, right? So at this stage that is sufficient. We have seen what how a profit and loss account looks like, right? We'll have a detailed discussion of this in the next chapter, chapter 5, right? In chapter 5 we'll be discussing each and every item that occurs in the P&L account in detail. So with this we'll stop at the P&L account. We'll now look at another financial statement called the balance sheet. So we'll have a look at the balance sheet of Reliance Industries for the year 31st March 2012. The font is a bit low here. Maybe we need to zoom in. Please see if you can zoom in your just see if you can do that on your computer. So I'll tell you what actually this figures tell. So the one point we can straight away observe is balance sheet is as at a particular year, right? As at. So earlier we seen that P&L account is for a period, so it is for a particular period, for the whole year, for 2011-2012. For this, so an item called sales will be listing the cumulative sales for all the 365 days put together, right? Whereas balance sheet on the other hand is a static concept, right? We discussed this. P&L account is a flow concept, whereas balance sheet is a static concept. So which means balance sheet will be telling us the position of the company as on a particular date, whichever date you want. So for this company, Reliance Industries, as on 31st March 2012, this is the balance sheet position. Please note that this position might be completely different the next day. On 1/4/2012, it might be completely different, or on the previous day, 33/2012, it might be completely different. What we are saying is the balance sheet position of the company as on 31st March 2012 is as follows, right? So the title of the balance sheet says as at. So each and every item of the balance sheet is on a particular date. And we already discussed the profit and loss account is a flow concept in the sense that it tracks the flow of the entire year, whereas balance sheet is only a stock concept of a particular date. And as is the case with the P&L account, we have two years financials, right? If you see in the previous slide. So here also we have figures for 2 years. One is 2011-12. Sorry, 31. This is not for the whole year. 31/3/2012. And in the next column we have 31/3/2011. So figures for 2 years are available. This enables us to compare the position of the company vis-a-vis the previous year. Okay. And we have discussed earlier that balance sheet always tallies because of the dual aspect. And as you can see in this example, the balance sheet has tallied. So the total of all liabilities item and the total of all assets item is actually tallied to 2,95,140 crores. The figure is immaterial, but this is something to be expected. I don't think so you'll be coming across any balance sheet that doesn't tally. In fact, that's the minimum job of the auditor. So anytime you come across a very a balance sheet that does not tally, I mean, it's a very shabbily done job by the auditor. I don't think so you'll be ever coming across such scenario, right? Usually balance sheet tallies. So there is something, a phrase at the end I have, if you have observed, I know the font is a bit low, but there is this a term called significant accounting policies, and for this we have a separate note. So if you go to that particular schedule, you're having a detailed discussion on the significant accounting policies. So what are these significant accounting policies? So you see, accounting policies we'll see shortly. We'll see in our future chapters. Accounting policies can drastically affect the profit of a company. There are many policies that can affect the profit of a company. Take for example inventory valuation. Right, in balance sheet we have an item called closing stock. Right, this appears both in P&L account and balance sheet. So in the P&L account we have income, and then we list all the expenses, and finally we arrive at the profit after tax. All right, so in the P&L account you'll be having income, any other income which you have. This is the core income and this is the other income, and then we have some expenses, and finally we have the profit after tax. Somewhere in between you'll be having an item called let us say plus opening work in progress minus closing work in progress. We will see where it comes in the future chapter. And then we have plus opening finished goods minus closing finished goods and stuff like this. So please note that even in expense there is something called raw material. Even raw material we have actually we take the raw material consumption. We are going to discuss all this later, so don't worry. Just I'm giving you a brief idea. So raw material consumption also actually flows from raw material purchases plus opening minus closing. So you see a number of instances where closing stock is up. This closing stock can pertain to raw material, it can pertain to work in progress or finished goods. So what I'm saying here is, if you change the value of the closing stock, right? If you change the value of the closing stock, the profit will be affected. If you increase the closing stock, if you increase the closing stock, your profit will also be increasing. Why this happens we will see later, but this is the point that you need to remember. And closing stock is actually valued. Now who values this closing stock? The company obviously values. So the company will be having some stock in the godown, right? And at the end of the financial year, 31st March 2012, it does a physical check. It does a physical check and it sees it does a physical check and sees what is the inventory. Say for example there is some 100 tons of material in the godown, and then it applies some rate, right? It applies some rate because balance sheet will be listing the value of this stock. So we are not considering the quantity, we need the value of the stock. So what is the say for example 100 tons of raw material, 100 tons of raw steel, right? Steel is available in the godown. So what is the rate you're going to apply here? You can apply 40,000 per ton or 50,000 per ton, 45,000 per ton. So what is the rate you're going to employ? So please note that here there is some discretion available to the company. There is no fixed rule as to what you have to. Again, there are some principles that guide what you should be doing, which we discussed earlier. There are some generally accepted principles. There are some accounting standards. They guide you as to what is the best approach to be taken, but they're not hard rules, right? So there is some flexibility in choosing which method to follow. So based on that, if you want to artificially boost your profit, you can employ a different valuation method and have a different figure for closing stock, right? So if you want to, for example, have a lower profit for some reason, like you want to evade tax, then you can show a lower closing stock. So what I'm saying is the profit figure itself is subject to the vagaries of the policies which we employ in accounting. And accounting policies vary on a broad range. You can have accounting concepts that are very conservative, and you can also have accounting policies that are very aggressive. So based on this, your profit will range from a low profit to a very high profit. So you don't know, it can fall anywhere in between, and it's at the discretion of the company. Of course, there are auditors. The balance sheet has to be audited. The auditor will be commenting on this, and that's why we have a item called significant accounting policies. In this particular section, the auditor will be the commenting on the significant policies that have a effect on the financial position or the profit of the company. So if the auditor feels that there is a policy that has a significant bearing on the financial position of the company that needs to be brought to the attention of the stakeholders, the whoever is per using the balance sheet. If it is such an important policy that needs to be brought to the attention of the stakeholders, then he'll be mentioning in the significant accounting policies. So please remember, significant accounting policies is something that you should always read in conjunction with the financial. So it's a integral part of the balance sheet, just as notes to accounts are integral part of balance sheet. You should always read balance sheet with the balance sheet figures in conjunction with the significant accounting policies. So you might get the one doubt here. So a company wanted to artificially increase the profit. So it has chosen some accounting policies. Please note that valuation of inventory, that the closing stock which you consider, is just one of the accounting policies. There are many items which you can manipulate to get a different profit figure. So we're taking just one example. There are many items which you can have a different accounting policy to suit your purpose. So we have an example of a company has increased its profit by choosing an accounting policy as per its requirement. Okay, it has done that. Now my question is, why should a company then go on to state that in the significant accounting policy? If the purpose of the company is to, it has done something wrong, it has done something wrong in increasing the profit by choosing some policy, why should it bring to the notice in the why should it bring it into the balance sheet in the form of significant accounting policies? Why it can't hide it, just be silent? Why it can't be silent? Why should it actually discuss in the balance sheet, and then everybody knows it, and then they'll be commenting it adversely? So why should they do that? Why not be silent? Why not follow a policy and just be silent? So here you have to understand that balance sheets are audited. So the auditor who does the audit has his reputation at stake while doing this job. Imagine a big company, a multinational company like Reliance or Bajaj, speaking of some very big companies. So they don't go to a small town, right? They don't go to a small town and see the auditor at that particular town, and they ask them, come on, you audit our financial, and then they say, we have a profit of 100 crores, but you do something and show us a profit of 200 crores. They don't do that, right? They don't do that. The reason being, the company being of such a high stature, they also need an auditing firm of that stature. So there are some auditors who are some very reputed auditors. We have the big four auditing firms, the big four consulting firms, right? For example, we have firms like accounting firms like KPMG. Then we have PricewaterhouseCoopers. And these big firms, these big auditing firms, have their reputation at stake. They can't do whatever the company asks them, right? Because they have their own reputation. Tomorrow, because balance sheet is a public document, isn't it? Balance sheet is a public document. So tomorrow, nobody should comment adversely on the work done by the auditor. So because these auditors have a reputation at stake, they'll be doing a professional job. Okay, we had instances where even major auditing firms had been in the dock for colluding with the management of the company in presenting inaccurate information. Yes, there were such instances, but we are speaking generally that the reason why significant accounting policies are mentioned specifically is the auditor wants to be safe, right? Now, this being the case, you also need to remember that if it is a small firm, right, a firm with very small turnover in a small town, see, you can work in your head office, or you could be working in your regional office or circle office. You can be working in a branch. See, in this level, maybe you'll be dealing with very large companies with big turnover. Auditors are pretty reputed, so I mean, there could be some fudging around. The figures could be fudged, but at least you'll be having a professional work done by the auditor, right? You can scrutinize the balance sheet. But when you come to very small accounts at the branch level, at the ROCO level, zonal office level, so what happens in that case is, when you have a small firms like proprietorship firms or partnership firms, there you won't be having such a detailed balance sheet, right? In fact, balance sheet, you'll be surprised to see that there's some balance sheet that is just one page, right? So on the top you'll have P&L account, income is listed here, and expenses listed here, profit. In the same page you have a balance sheet. liabilities listed here. I mean, you'll come across this sort of situation, just single page thrown at you and saying this is a balance sheet. That's not surprising, right? Not every balance sheet needs to be so detailed as we have discussed in case of multinational companies. But then the point I'm trying to make is at the level of small firms, there is more scope for accounting gimmicks, right? So because the scrutiny will be that much at a lower level. So even though balance sheet is a public document, a balance sheet prepared by a small auditor for a small firm will not be subject to that level of scrutiny. In fact, the only outside person that will be looking at the balance sheet is you. So please keep that in mind. There will be a greater scope for fudging the accounts at the case of lower firms, the small firms. So you need to be aware when analyzing balance sheets of small companies. Please keep an eye on who are the auditors, the regular auditors who are dealing with you. Please try and drill down to the best possible extent, right? Yeah. You'll get a fair idea once you do a lot of balance sheets, which auditor is is playing into what games, right? So you'll be knowing that. And also, if you keep your ears open to some of the parties, you'll be dealing with a lot of parties. You'll be having connections with a lot of professionals in your field, your seniors. So you'll have a fair idea of what are the games auditors be playing, right? So please keep that in mind. So at the end of the day, auditors are subjected to to a supervisory mechanism by their professional organization. So all auditors here, CAs, are under uh, the umbrella of ICAI. So there is a professional organization. So there will be some professional ethics going on. But then will also be having guilty auditors. So you need to be careful, right? Usually we rely on auditors' reports. So why do we always insist on please submit your audited balance sheets for 2012-13? Why do you say that? Right? The company might say our provisional financials are ready. Sometimes you come across this term called provisional financial statements. So provisional financial statements are something which are prepared by the company. They're not yet audited, they're tentative figures. But we say we don't want that. We say please submit your audited financials. Now these are fine for a temporary purpose. Maybe for the year ending March, we are in April, we're in May. So since the auditing is not completed, okay, we will accept these figures and say please submit your financials. But come June, come July, come August, we insist on audited financial statements. So there is some respect we place on financial statements that are audited, in the sense that auditors are independent professionals. So we place some trust on them. But then that doesn't mean you should be trusting them blindly. So there should be a delicate balance that you need to be doing, right? Let us see one more financial statement, and this is a cash flow statement. Now the font is really small here. In your computer, I think you can zoom. So this is a cash flow statement of Dr. Reddy Labs, right? So again, we'll have figures of 2 years, right? Though you cannot see this. This is for 2 years. The one is on 31st March 2012, and another is 31st March 2011. So what this cash flow you can readily observe is cash flow will be having three separate headings. Cash flow from operating. This is not clear to you, but this is cash flow from operating activities. Then we have another set called cash flow from investing activities, and finally we have of cash flow from financing activities. So cash flow usually will be broken down into these three separate heads. So is cash flow as on a particular date, like a balance sheet, as on a particular date, or is it for a particular year, like P&L? So what is the cash flow, right? So as the name suggests, it's a cash flow, right? So it is telling you the movement from one year to another. So it's like a P&L, right? It's a flow concept. Okay. So this is what we discussed. Cash flow will be broken down into operating, investing, and financing activities, and it is a flow statement. Okay. So there are a couple of points which we'll be discussing before we end this chapter. One is, why is the balance sheet always prepared on the March 31st of a year? So usually the calendar year, as you know, is to Jan to December. So why not have a balance sheet on 31st December, right? Why not we do that? So yeah, I mean, there's nothing wrong in it. First of all, you should know that there is nothing wrong in doing that. There are some companies that prepare the balance sheets they close their accounts on 31st December. But usually you see that most of the accounts are closed on 31st March. So this is not just peculiar to India, by the way. Many have a misconception that this is done only in India, but even in foreign, many countries, in many companies, abroad also have this convention. So one reason from a Indian perspective is the Income Tax Act. The IT Act was actually promulgated. It came into force from April 1st, 1962. So that is one reason why many feel that financial year begins on April 1st. But the other reason is India is basically an agricultural economy, and see the revenue actually depends on the outcome of the main crop, which is being ripe in February, March. So that is another reason why we have accounts being closed in March. But as I told you, that is it's not peculiar to India. Many countries abroad, many companies abroad also follow this convention. So one other reason which is usually cited is December is a very busy time due to Christmas. So many employees go on vacation, and so valuing inventory is very difficult. So if you need to close your accounts, you need to actually arrive at an item called closing stock. So on the particular date, you need to value the inventory. So this is a very time consuming process. So maybe due to shortage of stuff, and also sometimes the level of inventory is very high in this particular month because the companies need to stock a lot of inventory for the holiday season, the Christmas and New Year. So actually inventory will be very high in this particular month. So maybe valuation will be time consuming. So whatever it is, the point that I'm trying to make here is usually the figures are closing March 31st, and in India usually see this very common. But there's nothing wrong. There's nothing wrong if you want to close your accounts on any other date. It could be 31st December. You could also close on 30th June. That's your wish, right? And the other point that I will tell you is about the format. You see, we have seen a P&L account, we have seen balance sheet, and we have seen cash flow statement. And we've seen taking examples of three different companies, Bajaj, right? We have taken example of Reliance of balance sheet and Dr. Reddy Lab. And you might ask me, why didn't you show other company, right? See, the point is, even if I had shown you other company, only the figures vary. The format will be exactly similar. So this format is actually prescribed by something called Schedule 6 to the Companies Act. And Schedule 6 to the Companies Act prescribes the format to be followed for the balance sheet and P&L account. There is another important point that I would like to bring to notice at this stage, that there is something called a revised Schedule 6, right? So for the period commencing after April 1st, 2011, you need to follow revised Schedule 6. So we will come to this point in a separate chapter. I will be telling you what is this revised Schedule 6 and in what way it was different from the original Schedule 6. So we'll be discussing in a later chapter. But for the moment, just remember that balance sheet and P&L account have a particular format, and that is prescribed by the Companies Act. So every company follows that particular format. So with that, we come to end of this chapter. It's been a chapter where we discussed the bare basics of the financial statements. We didn't go into depth. This chapter was not meant for that purpose. We are going to do that in the subsequent chapter. So in the next chapter, chapter 5, we'll be discussing the item-wise discussion on the P&L account. So we'll take what are the various items that can appear in a profit and loss account, and item by item we'll be discussing each item in detail. We'll be discussing what it actually means, what the item means, how it is to be treated from an accounting perspective, what is the classification for a purpose of a banker, and what are the other points you need to be keeping in mind when you encounter that item. So we'll be discussing the item wise points on profit and loss account in the next chapter. See you then.